Broadcast is now starting. All attendees are in listen-only mode.
Thank you for joining us today for our webinar on Brexit. So today, myself, Mira Raja and Sharon Bedford are going to talk to you about a no-deal Brexit. We're going to cover some of the issues and hopefully give you some top tips. So thank you for joining us. After 2 years of failed negotiations and political uncertainty, with less than 7 weeks to go, we're uncertain as to what type of Brexit we're actually going to get. However, most pundits are now in agreement that there is an increased likelihood of a no-deal Brexit. So we're going to ask a poll question that should be on your screen. If you could please all answer the poll question, and then we will come back to the question at the end of the webinar. We're still waiting for the questions to be answered. So at the moment, it's pretty split in terms of understanding the impact. So during today's webinar, we will run through cross-border business operations, looking at supply chain, talk about finance, about companies employing EU citizens or sending employees to work in the EU, legal and regulatory issues, VAT and customs impact of a no-deal Brexit, and also look at companies relying on tax breaks governed by state aid. So there are still a number of possible outcomes between now and the 29th of March. However, they broadly fall into three possibilities. One, no Brexit, certainly for now at least, and this could mean that there's another UK referendum, or the UK government chooses to extend or revoke Article 50. Another possible outcome is the Irish backstop issue being resolved and a soft Brexit being agreed, with a transitional period of 20 months ending December 2020, and then the UK and the EU could then move on to agreeing a future relationship. And that could be a free trade agreement or based on an existing model such as Norway or Canada. And finally, the option which is getting more and more likely, and what we're going to cover during today's webinar, a hard Brexit, with no deal being agreed and the UK leaving the EU on the 29th of March. So the first area we're going to consider is cross-border operations and supply chain. Following a no-deal Brexit, new customs formalities will require checks at the border, and this will almost certainly lead to delays, blockages, and that's in the UK, EU, and the rest of the world. Your suppliers will also have to be prepared for additional custom duties, processes, and requirements, or to be prepared to experience delays. So what could you be doing to mitigate against supply chain risk? Well, firstly, speak to those involved, particularly your suppliers, freight and logistic companies, about potentially exploring different delivery routes, modes of transport with quicker delivery times, and if you can, look to bring goods in earlier, so you don't have goods crossing the border on or shortly after the 29th of March. You should also be having conversations with your key customers about their requirements over the coming months and what they should be expecting in terms of delivery times, just so that there are no major issues that could cause a strain on the relationship. You don't want to be in a position where your customer expects you to be able to deliver a significant amount of goods in a short space of time when you can. If you have concerns about your current suppliers, you should consider finding an alternative supplier or dual sourcing certain goods. This way, if you have doubts about your current supplier's ability to supply goods for whatever reason, you have an alternative option, which means that your supply chain doesn't fall down. A number of our clients have chosen to stockpile goods to ensure they have excess supplies to cover additional operations in the region of 3 to 9 months. This will hopefully mitigate against any delays at the border. In one particular instance, our client has actually gained new customers by guaranteeing to have stock during this period, and the current suppliers can't do that, so they have a unique advantage. Although stockpiling has advantage, there are clearly risks such as obsolescence, price risk, and storage risk. However, one of the biggest challenges is managing your working capital, which brings us on to finance. Stockpiling goods will put a strain on cash flow without extended credit terms. Customers may not pay in a timely manner if goods are travelling overseas and stuck at customs, and you may be liable for goods stuck at the borders, all of which will put a strain on cash flow. That's before you consider the increased costs because of potentially using different logistic options such as air travel instead of at sea, the cost of using new suppliers, additional storage costs, taxes and additional duty costs. On top of this, there will be a fragmentation of financial services, and this could bring challenges to accessing capital and existing lines of credit. And there's almost certainly going to be exchange rate volatility in the event of a no-deal Brexit. So what could you be doing? We would advise companies to prepare and monitor cash flow projections and budgets to identify financial risks specific to your business. Use these forecasts and budgets as a basis to speak to those involved in your business to help overcome your working capital and funding challenges. Discuss extended credit terms with suppliers. Ask customers to pay in advance, and you can encourage this by offering discounts for prompt payment, and speak to your bank and any other lenders. Discuss your plans with your lenders and work with them to identify a solution that is right for your business. We have recently been working with the client and their lender in identifying the right funding options available for them. We have worked with them to look at the pros and cons of various common lines of credit, such as overdrafts, loans and invoice discounting, and helped identify the most suitable form of funding for their plans during these uncertain times. One thing to be aware, if you have any bank covenants, it's imperative that you consider the impact of any adverse foreign exchange movements that could put you and your business at risk of breaching your covenants. We recommend that you identify the risk by performing sensitivity analysis on your results and budgets, and speak to your lenders if you believe you may be at risk. You will hopefully be able to review or waive the covenants or discuss a strategy to overcome any non-compliance. This could involve putting in place a formal hedging policy for the foreseeable future, such as purchase of hedging instruments such as forward contracts, future options and other derivatives, or looking to hedge naturally using normal operating procedures, which can be done by receiving income and expenditure in the same currency. So companies employing EU citizens or sending employees to work in the UK. So following Brexit of any outcome, EU citizens in the UK will have to apply for settled status to continue living and working in the UK. However, the European Temporary Leave to Remain scheme will allow EEA citizens arriving in the UK after the 29th of March to live, work and study in the UK for 36 months from the date of their application in the event of no-deal Brexit. After this period, if an EEA citizen wants to stay in the UK, they will need to apply for immigration status under the new immigration rules, and these will come into effect from the 1st of January 2021. As for UK nationals working and living in EU countries, their rights will depend on what the EU country decides. A further issue is the fact that existing qualifications may not be recognised between the UK and EU, although the UK government are trying to agree mutual recognition status with other EU member states. It will also become more difficult for UK nationals to travel in the EU and vice versa, and it is widely assumed that post-Brexit it will be more difficult for low-skill and lower-paid workers to work in the UK, and therefore UK companies could lose a significant amount of their workforce. So what could you be doing to prepare for a no-deal Brexit? Firstly, review the UK government's advice on settled status. Consider putting policies in place for retaining or hiring non-UK EU nationals, and travel policies for UK citizens living, visiting or working within the UK or vice versa. And when putting plans in place, please obtain advice from your lawyers and accountants to ensure that you've considered employer and employee rights and any tax implications. Moving on to legal and regulatory issues. Some of the following a no-deal Brexit, some industries, regulated industries, will need EU authorisation to supply to the EU market. These industries are typically like financial services, pharmaceuticals and other industries. An additional authorisation for the the UK market subject to any temporary permissions granted by the UK under a no-deal scenario. However, the UK government has announced it will allow goods that are made and assessed against EU regulatory requirements to be sold in the UK for a temporary, currently unknown specified period of time. There may be potential losses for protection of trademarks, registered designs and copyrights, and multiple intellectual property filings may be required. In the absence of any deal with the EU after Brexit, the UK and EU have guaranteed that grant funding will still be available until 2020, and UK companies will continue to be able to participate in bids. However, for other public procurement contracts, the default position will be under the World Trade Organization rules, and that means no mutual rights of access to public procurement markets. Therefore, although the UK could favour British companies, UK companies could also face discrimination in supplying the much bigger European procurement market. Regarding audit and reporting, it will largely remain unchanged in the event of a no-deal Brexit, but there could be additional requirements for audits of UK companies operating cross-border. The structure of certain groups and companies may give rise to new obligations. UK incorporated subsidiaries and parents of EU businesses will continue to be subject to the UK's corporate reporting regime. However, certain exemptions in the Companies Act relating to the preparation of individual accounts will no longer be extended to companies with parents or subsidiaries in the EU. So what could you be doing to prepare for a no-deal Brexit? Review existing products or services alongside regulations and information provided by the EU and the UK's no-deal Brexit guidance for your specific sector. If relevant, engage with the relevant notified body. Review what intellectual property rights you hold and where. Consider setting policies for the registration of future intellectual property based on your company's strategic, commercial and financial needs. And if you are unsure, obtain advice from a patent attorney. You should be reviewing your current legal structure, determine if it's suitable or whether there are more suitable alternatives available. And finally, determine your future financial reporting requirements to ensure that you're aware of your responsibilities and that you have sufficient resources to meet any regulatory requirements. If you're unsure, consider speaking to your accountant. My colleague Meera Raja is now going to talk you through the VAT and customs impact of a no-deal Brexit.
Hi everyone. I'm going to talk about the VAT customs impact of no-deal Brexit and hard Brexit impact for goods arriving in the UK from a non-EU country. If the goods arrive in the UK from a place outside the EU, including China, the potential impact is import VAT will not have to be paid and reclaimed as currently, but rather 2 entries on the next UK VAT return of imports are called postponed accounting. It will benefit cash flow, removing the current time difference between paying the import VAT to HMRC and receiving it via the VAT return. The current method is that to clear the goods, you have to pay the VAT, import VAT and duty and port, and before you clear the goods. That is the current system, and then you claim the import VAT in your VAT return. What has been agreed and what will happen from the 30th of March is that you just have to give your VAT number when you arrive at the port with the goods, and then you include that it'll be 2 entries as an in and out entry in your VAT return, and that will be it. So you don't need to, there's no cash flow impact, or you don't need to pay the import duty upfront. To do this, you need to notify HMRC to say you are going to go into postponed accounting. The UK will no longer have to use EU tariff rates for imports from third countries, so could potentially either increase or decrease import duties on goods arriving from non-EU countries. Currently, the tariff is all the same for all the EU countries. So if you're going to come out of the EU, then it is not going to be, we can then decide what the tariff is going to be. It is very unlikely that import duty rates will increase immediately after Brexit, given the need for the UK to develop new trading partners. Impact of goods imported from the EU. Currently, whilst the UK is part of the EU, goods travel with minimum documentation and without VAT or customs duty. So there's no queue, there's a separate queue for if you are trading within EU, and then people will go straight through. Post-Brexit, these arrivals from the EU will be treated as imports rather than arrivals, and full import declaration is called C88 or SAD, which is Single Administrative Document, will have to be submitted to UK Border Force or Customs to release the goods into the UK using a newly introduced Custom Declaration Service. HMRC have indicated recently that a transitional simplified procedure will be introduced for at least 12 months to allow importers to submit a simple entry on arrival with a more detailed entry to follow within the next 24 hours. This will be good to, I think this is the main reason for this is to reduce the traffic and also the queuing system. But nevertheless, the administrative burden and the paperwork, you still have to do that. It just gives you 24 hours to do it. Then the possible physical delays at the border as the shipments are subject to more documentary custom checks. This impact is disputed by politicians at present, but we just have to wait and see. But this is because of the extra documentation, the likelihood is there's going to be long delays. Possible import duty, a permanent non-refundable cost dependent upon the tariff clarification code and if preferential rates are available for each specific tariff heading. So the import duty is what you have to think about. If you're going to get goods in from the other EU country, there will be a duty which you have to pay, and it is non-refundable. Import VAT, although it will be subject to postponed accounting, that's a new thing for dealing within the EU. Particular potential concern for two scenarios. Just-in-time importers who currently order at short notice. At the moment, within the EU, you can order with very short notice. You want something, a massive stock for the next day, if somebody's got the stock today, and you can deliver it. And that you need to think about it, because it's not going to be that easy, because you need to do the custom declaration. And also when the goods arrive in the other side of the EU, if they don't, if it's not one of the countries with postponed accounting system, then they have to pay the duty and the VAT to clear the goods. So that is something you have to start talking to your suppliers and customers about. Business models where goods currently move to and from between EU member states for processing before final manufacture. Again, this is all, if it's currently within the EU, it's business to business, they can bring in their goods, and then you can add to it, or you can modify the goods and the goods can go out of the country. But all of that is going to have a big impact after Brexit, as there will be duty and import VAT involved. End of VAT simplification procedure called triangulation. This is a big thing at the moment, which is it will affect most of the goods customers who are currently dealing within the EU more than one country. A business-to-business movement of goods called triangulation. A VAT simplification system in the EU that prevents the seller and intermediate supplier from registering for VAT in the member state where the customer belongs. If I can take you through this diagram. At the moment, if you see there's a UK intermediary, the German supplier sourcing goods from the UK intermediary and asking him to send the goods directly to their customer in Spain. So the only thing the UK intermediary has to do is to invoice the German supplier, and the German supplier will invoice the Spanish customer, and the UK will send the goods to Spain. But when we come out of the EU, this cannot happen because we are not in the EU. So that's going to have a big impact. So it will be import duty paid, import VAT paid, and this will not work from the 30th of March. Right, Now we're going to talk a bit about the summary of advantage of Brexit. Introduction of postponed accounting for all imports into the UK, both non-EU countries and the EU, leading to improved cash flow. This is a good thing at the moment because currently non-EU countries, when you bring in the goods, you have to pay the import VAT, and it's still a huge cash flow problem. I know you get it back, but you still have to wait. If you're not on a monthly VAT return, you wait for 3 months or 4 months to get that VAT back. But just by giving the VAT number and doing a in and out entry in your VAT return, you don't have to physically pay that money. So this is pretty good. It's not just for the EU countries, or it's also will have an impact on non-EU countries bringing goods into the UK. You don't have to do EC sales list from the 30th of March, and no interest act declaration. So slightly less paperwork for those two. End of distance selling of goods, business to customer to the EU. No requirement to register for VAT in the EU unless UK business holds stock or has an establishment in the EU. But import VAT may be collected by the tax authorities and customs at that member states. Currently, if you do business to customer, you have to keep an eye on the threshold if it's distance selling, and then you will have to register in that country. When we come out of the EU, that will be treated as outside the scope of VAT, so you don't have to, even if you're doing business to customer, you don't have to, there won't be a requirement to register in that EU country. New EU VAT rules will remove the existing zero rate intra-EU sales goods in 2022 anyway. This is, I'm not sure how many of you were aware, but from 2022, say for an example, you're selling goods to Germany, it was going to change. They were going to remove the zero rate, and they were going to come up with something like where we charge the German VAT here in the UK, and the HMRC will collect it and then pass it to the German authorities. That was going to happen anyway, so we just bringing it forward by saying that there's no more zero rating. Summary of disadvantages of Brexit is, like I mentioned before, and also James mentioned it, possible delays in movement of goods moving between EU and UK, especially in short term, it's mainly due to increased documentation. Increased costs for goods moving from EU to UK, primarily freight agency fees. Our advice on that would be is that you start talking to different freight agencies, think about different ports. At the moment, Dover seems to be the easy option for people, familiar, but I would, try talking to other freight agencies, also try other ports like Felixstowe, Portsmouth, Southampton. Some of our clients have started doing that. Worst case scenario of double import duty, once when the goods arrive in the UK, then again when they move to the EU. So when you bring in the goods into the UK, if it's coming out of the UK, then that's import duty you have to pay. Then when you are sending the goods out to a customer in the EU, then the customer will have to pay import duty to clear the goods. For those EU countries without postponed accounting and negative cash flow with delay between paying and reclaiming import VAT. So you really do have to speak to your customers in the EU, if you haven't already, that if there's very few, 6 countries at the moment who's got this postponed accounting, the Cyprus, Germany, Ireland, Italy, Slovakia and UK now. Everyone else will still have to pay the import VAT to clear the goods. So they will have an impact. If you are going to continue to sell to those customers, you really do need to speak to them about how it's going to impact them, and that they will have to pay the import VAT and duty at their end. Other VAT implications: UK businesses will have to switch to the non-union EU VAT refund scheme to recover cost on trade fairs, etc. Manual claim rather than online, sent to EU member state rather than to HMRC in the UK. Currently, any businesses incurring any cost in, for example, France, Spain, or Germany, we do an online claim via HMRC portal, and we don't have to individually write to those countries. We do one claim, putting the country code, and the money comes back into your account. But from the 30th of March, we cannot do that. It is going to be a paper exercise, and we have to send it to the member state to recover this cost. Mini one-stop shop, which is also known as MOS. UK businesses who sell business to customers digital services to consumers in the EU will have to register for MOS somewhere else other than the UK. Currently, if you are supplying electronic or digital services to customers, business to customers within the EU, you just register for this mini one-stop shop and you charge that individual country VAT via that system, and then you do one submission. Since we're going to be out of the EU from 30th of March, if you are currently doing this, you have to think about another EU country to register for MOS. Then you need to apply it from there. If you don't do that, you will end up registering in all those countries, which really you don't want to. If this is going to affect any of you, please do give us a call or get in touch with us and we can help you with that. Tour operator margin scheme, which is also known as TOMS. The future is unclear for this implication scheme. We haven't got too much detail on this, how they're going to change the scheme for this. So as soon as something comes out, we will send something out to all of you guys so you'll be fully aware of it. Possible solution: consider whether it is practical and commercially feasible to establish a base in the EU. Some of our clients have already done that. They have found a small establishment in Belgium, Malta, wherever people are, or Ireland, wherever they can, for the language, and where some of the countries give incentives for new businesses, so they have moved. So that's something to consider. Warn your customers in advance that in the immediate aftermath of Brexit, there may be delays at the UK border. So if possible, they should submit orders as soon as practical. So this is going back to my previous slides when I was saying that short notice orders, I think you probably need to warn them to say that's not going to be feasible after the 30th of March. Immediate actions to mitigate no deal. Apply for an EORI number. EORI number is electronic operator registration and identification number. If you don't already have one, you need this because all the goods which is going to come into the UK and go out of the UK, you need this number. You need this number for import and export. So please do apply for this. Sign up to transitional simplification process via HMRC website. It is a pretty straightforward one. Submit EU VAT refund scheme to HMRC for 2018. So all of your 18 in the past, you could have done it till September. But now, because we are coming out of the EU, please try and do this before the 29th of March. Then you can do it via the HMRC portal rather than doing a paper submission. If currently, submit MOS returns and sell digital services to EU consumers, register for MOS in the EU by the 10th of April. So this will also mitigate you registering in other countries. So if you guys have any questions, please post it. We can answer it at the end of it. I'm going to hand over to my colleague Sharon Bedford to take you through the rest of it.
Thanks, Mira. I'm sure you'll all agree that the complications for VAT and customs duties is probably going to be one of the biggest challenges that most businesses are going to face in the next few months. By contrast, the direct taxes impact is probably lower, but there are a few things that it is worth just touching on, and I just want to complete our webinar today by doing that. Firstly, state aid. So by way of background, the EU state aid rules are designed to prevent EU member states introducing measures which will distort competition in the UK. They cover support which gives a company or other organisation a benefit that could not otherwise be obtained during the normal course of business. The support can be in any form, it can be in financial or in kind, and from any level of government, central, regional or local. And these rules are currently governed by the EU legal framework, and as long as the UK is part of the EU, we are subject to those rules which are enforced by the European Commission. And currently there's no specific UK legislation relating to state aid regulation. That's relevant because tax policy falls squarely within the state aid rules. And you're probably aware that in recent years there have been some really high profile state aid judgments relating to tax. For example, in 2013, the European Commission concluded that Ireland had granted undue tax benefits to Apple of about 13 billion euros. And in 2017, they concluded that Luxembourg had given illegal tax benefits to Amazon of about 250 million euros. Those cases are still being contested, but nevertheless, those are large numbers. Now, immediately after the in-out referendum, there was a lot of speculation that the UK could become at a competitive advantage going forward, because not being subject to those state aid rules to the same rigour, it could bring in more relaxed tax rules to help attract overseas investment, it could potentially reduce tax rates, etc., etc. However, at the current time, it appears that this is unlikely to be the case. The government have confirmed that they support a rigorous state aid system and that the EU state aid rules will be transported into UK domestic legislation under the EU Withdrawal Act. So, in the current projection is that there'll be no short-term changes. And going forward, these rules will be monitored by the Competition and Markets Authority. So does this have a knock-on effect to companies relying on tax breaks covered by the state aid rules? So currently, if a member state, like the UK, believes that a tax break will deliver growth or some other important objective, they can apply for EU approval to put that tax break or incentive in place. And UK examples which currently fall under that state aid approval are EMI share option plans, very common share option plan put in by many smaller companies and indeed many of our clients. The Enterprise Incentive Scheme, which allows smaller companies to attract investors by giving tax breaks to the people subscribing for shares, and something that's benefited a lot of UK companies, which is R&D tax credits for small and medium-sized enterprises. Now, as the sort of Brexit, no Brexit debate's been oscillating backwards and forwards, there has been quite a lot of speculation about what will happen to these incentives. I don't think anyone really thought they would disappear, but there has been quite a lot of speculation that there'll be a hiccup or a hiatus in a period where they fall away before they can be reinstated. Interestingly, I think that what's probably the case is in a no-deal Brexit, the situation is possibly clearer in that, certainly my reading of how the things will move forward is that hiccup is probably less likely to apply. However, it will need appropriate enabling legislation possibly, and therefore, that needs to be just watched, and please do talk to us if you're at all concerned about that. Just on that though, I think whilst there might be no short-term changes to these sorts of incentives or others, I do think it's worth just reflecting for a little minute on what might happen in the medium term. Having to comply with EU rules on state aid in these incentives has arguably resulted in overcomplicated rules. It also means that changes can't be made very easily, for instance, in a UK budget. So it's generally hoped, therefore, that in time, and it will take time, there may be some simplification in the rules around these incentives, and possibly they may become more generous. Just to conclude then, a few comments on those of you that have businesses which either have subsidiaries or parent companies in the EU or ones where you have significant EU cross-border activity. Currently, many groups with EU operations rely on EU directives to give them tax breaks, and it's expected that these will no longer apply following a no-deal Brexit. For example, there are currently directives which generally allow interest and dividends to be paid between EU countries without the deduction of any withholding tax in the country in which the payer is resident. And there are other directives which deal with cross-border reorganisations and mergers. Following a no-deal Brexit, the UK will have to rely on its network of double tax treaties in the same way as it does now with non-UK countries. The good news is that UK does have double tax treaties in place for each of the 27 EU countries, so the framework is there. However, some of the treaties have not been modernised, as the EU directives have meant that this has not been necessary. Leaving the EU could therefore mean that withholding taxes might apply where otherwise this may not have been the case. A couple of examples include payments of dividends from a German subsidiary to a UK parent, now free of tax, but a 5% withholding might apply immediately post-Brexit, no-deal Brexit. And payment of interest from Italy to a UK company, currently no withholding, but that's likely to be 10%. So if you are involved in any such transactions, please speak to your advisors as soon as possible, just to see if there's anything that you can do before the Brexit date. And just in general, we would suggest any potentially affected groups seek advice sooner rather than later, because it may be that their international structures need revisiting. Anyway, before you finish, please can you take a few seconds to answer our poll question again? Thank you for doing that. That concludes our webinar for today. We hope you found the information helpful. It may well have resulted in more questions than answers. We do appreciate that. We have a short period of time. So if you do have any further questions, feel free to contact one of us, and our contact details are there on the screen. Just to finish off, it seems to be that a greater percentage of you have a little bit more clarity following the webinar than you did at the start. So thank you very much for attending.
Yes, you can ask. I understand some of you got some VAT questions. Yes, of course, you can ask those. You can post them now, or email me, or call me. Is there any source of one of the questions is there any source, any way to find out the new duty rates? No, at the moment, because this is only be available after the 30th of March. Because I really can't see it going up. I think it'll remain for the immediate future. But then we don't have to listen to Brussels anymore, so we can decide whether we're going to bring it down. I very much doubt it'll go up, but as soon as we hear that, I'm happy to circulate something to say the new tariffs are available, but it's not available. You can get the current tariffs, but not what's going to be from 30th of March. I hope that answers that question. Where can we download the slides? that will be sent out. Whoever's joined this, we will be sending it out, so you will all have the slides. So I've got another. I'm trying to read the next question based on the.
I think there's a question about what happens with software services where solutions are sold. Perhaps Mira could give a very brief summary, but that's a very complex area, and we can certainly contact you directly and discuss that on a one-to-one basis.
Yes, it is. It is. Yeah, it is. I think I gather that you're talking about MOS, and please do email me, and I can answer that. The commodity codes for EU, no, we don't know that as yet, because they will have to publish that, I would think, before the 29th, or at least by the 29th of March, it should be there. Again, I will send a newsletter out, or we will put somewhere in our finance update where the links are, and you can download it from the HMRC link. Okay. All right. Thank you very much for listening to us. And as we said, if there's any questions, we are happy to answer it. Please email us or pick up the phone. Our details are on the screen now. Thank you.